In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning once again, Market Rebels. And yes, I said morning. It is bright and early here, and we are having to record this rather than the 4 p.m. normal time. Stu, do you have any futures? What's going on in the markets this morning? Had a nice little
Futures are
rally
really,
yesterday.
yeah, they're really flat though. I mean, we're less than, up very, very slightly,
Yeah,
less than 1/10 of 1%.
that's about as slight as you can get, but at least we're heading up. So at any rate, we came up with a topic, and Stu, I almost think that we've done it, I think, in so many different forums, but we get asked this a lot from our Q&As, and we just got asked about it last week recently, and that's what prompted me to do this for a topic. So if we've done it before, our apologies, but I've also added some different slides to it, kind of change it up a bit.
And it's
Again,
also good to review it again. It never hurts.
it certainly doesn't, but I couldn't find it anywhere, so I think I'm just thinking of some other forum where we did it. But it's
Yeah.
a phenomenal topic, and again, it's one that we get a lot. So let's start off with the chalk talk question, then we'll show you what the topic is. So let's say the stock is 100, 30-day 110 call is trading for 20 cents. Should you sell the call? Now, I know you know the answer, or at least the direction that we should lean, but a lot of people look for stuff like this because they say, well, there's a very low chance that I'm going to get called out, and so therefore it's free money. And so this is what they look for to sell. And that's really what a lot of the people are asking in the Q&As, trying to find these very far out of the money options to sell. So that's what we want to explore here. And then normally when you and I come up and we say, well, here's the way we would do it, they say, well, how did you come up with that strike? How did you come up with that expiration month?
Bill, you know what cracks me up, which is probably not part of this topic, but I'll mention it anyway because it does crack me up.
If it cracks
When
you up,
when
let's
the
hear it.
stock goes to like 112,
Uh-huh.
they get annoyed.
They get annoyed.
Oh my
Right.
God, it's
You
through
made a
my strike.
12% move. Right.
Are you kidding me?
Right. Here, if you want to get annoyed, go 12% the other way.
The other way. Yeah. Go to
Then you'll
90.
see what
Then
annoyed
you'll
is.
get
Right.
annoyed.
Yeah, and we're going to talk about that. It's a little bit of the perspective, which is always true for any strategy before you enter. You have to know what the deal is, what your risk graph looks like before you can make those decisions. But what we wanted to share with you, 3 key calculations for covered calls. I don't know of a professional trader anywhere that doesn't use these as a way of making decisions. A lot of platforms will even give these to you, or at least some of them, to help you make those decisions. So whenever Stu and I come up and say, well, here's where the way I would lean, I would go with this expiration in this strike. And again, there's no perfect answer, but what we're trying to do is channel people into the kind of the right areas to look. if you're doing covered calls. So for everyone who's ever done a covered call, thought about it, this is going to be a phenomenal topic for you. Good presentation. So let's do a quick review. Covered call. This is where you're going to buy 100 shares, or you've already got them in your account, and it could actually be more than 100. But for every single 100 shares, you will sell one call against it. So if you had 500 shares, you could do up to 5. Now notice
Up
I
to,
said up to. You're not required to cover the whole lot.
of course not.
But if you have 100 shares, you've got no choice. You either sell the call or you don't. So let's say that our stock is 100, the 105 call, we look on our broker's platform, is trading for $3. Our break even point is 97. And this is one thing, we'll talk more about that later. But all we're going to do is to take the current stock price, not your purchase price, not your cost basis. We don't care if you paid $10 for this stock.
No.
Right now it's 100. And so why do we consider that the risk, Stu? If we, let's say if somebody paid $10 for it years ago.
That's history, man. You can hit the sell button and you got your money.
That's exactly right. You can hit the sell button, put the 100 in your pocket. So the fact that you're saying, you know what, I'm going to hold it, bang, there you go. Your cost basis, or I should say the amount that you're putting at risk is 100, not
That's a
the
tough
price.
concept for some people because
It's a
they,
very tough concept, right?
some people have these stocks for so long, their grandparents gave them to them or,
Negative
whatever.
cost basis, right?
And yeah, they got a negative cost basis. But that has nothing to do with your risk profile at the current time. And,
Right.
one way to kind of overcome that misperception is to just make believe. I mean, don't go ahead and do it, but just kind of make believe you hit the sell button, you got rid of it, and then you just turn around a second later and bought it, and then you have it again. And after you did that, you have the exact same position, except now your cost basis is
Now 100, even though only
now
1
100,
second
and
time
now
passed.
you're up. Now
Right.
you're off to the races.
Yeah.
From a risk side, nothing changed whatsoever. It's just in your head.
Right.
So you gotta. Oh, it's always like now. From now you gotta move forward. Can't move back.
That's why we call it mark to market. As traders,
Mark
we
to
look at
market,
what the current
exactly.
price is, and a lot of people say, well, what is it for tax purposes? Not part of the discussion. What's my
No,
cost basis? Not part of the discussion. We're not saying they don't have their place.
that's
We're
correct.
saying for a decision about why I'm doing this strategy, the amount you're putting at risk in this example is 100. So now we could afford to have the stock fall to 97, $3 less than what we paid for it. I'm going to grab my pointer here. So we sold it for 3. So if the stock falls to 97, we just broke even. Whereas if we paid 100 for the stock, or we're holding it, we'd be down 3 or 3%. So it's giving us a little bit of a downside hedge. And that is the primary reason for writing the call, is for the downside hedge. And it is fixed. It's not a huge downside hedge, but it is a hedge.
Bill, it's not for free money.
It's definitely not free money.
I read
And
that
as our
somewhere.
risk graph here will show,
Some clown on YouTube told me it was free money when you sell a call.
lots of people do, right?
Okay.
So here's the thing. If we look at our risk graph, the black is the expiration curve, which remember means that we only look at that or refer to it right at expiration. Let's call it seconds going into the closing bell on expiration day. That's the only time you should refer to that black line. Now notice we get a bend at the strike. So here's the 105 strike that we sold. But prior to expiration, we don't look like that black line. We look like this blue. And that's called the current curve. I've heard some people call it the now curve. It's just what your risk graph looks like right now. This is also why we see this with spreads a lot too. The stock might be at 105 and people are going, well, how come I'm not at maximum gain? Because the risk graph says no. The expiration graph says you would be there at expiration. You got to wait another 30 days. There's no guarantee the stock's going to be here right now. It's worth this.
Which leads to the question that we get almost every day: should I wait until expiration?
Exactly.
And then people aren't thinking about, well, what could happen between now and expiration with the stock price?
How about down here?
And that's a discussion that you have to have with yourself.
Yeah. Everybody thinks when it comes to the covered call that this is the risk. They'll say, well, the risk is that you get called out or that you get assigned is really the
Time.
proper term. Well, look at that. That's the very best you can do.
Yeah, you want
How is that a risk?
aside from any tax consequence that you don't really want to happen, that's the best thing that can happen.
The very best thing that can happen. You knew that if there's a tax consequence you don't want, you shouldn't have written the call in the first place thinking that it was free money. That's just a
Or
bad
try to
decision,
roll it
right?
up or out or something, yeah.
That's Murphy's Law coming back for revenge. So we can see that right now we're curved. Kind of got the biggest part of the bend, our biggest gamma right there at 105. That'd be a little bit of a clue that we're looking at maybe a 105 strike, but we can clearly see it at expiration. So again, before you write that call, have a little discussion with yourself. Am I okay if I get assigned and have a max gain in this case of $8? That's the $5 capital gain. Remember the
On the
stock was
stock.
at 100. So we made $5 in the stock, we made $3 from the call, and we can see that it lines up right there at 8. Is that okay? Is that going to help you accomplish your goals in exchange for pushing the break even down to 97 instead of 100? That's really what the
And
trade-off is.
giving up that upside tail,
Yeah,
which you don't have anymore because you have your obligation,
that's right. You're flat.
right? You're giving both. It's both of those. You know, it's both sides of it. You're giving that up. That's an opportunity cost that you may have to
Yeah.
eat. You
And
know, and you
the
got to be
thing,
okay with it.
yeah, oh, it's absolutely true. Yeah, that's what you're giving up, which is why if you've got, like I said earlier, 500 shares and you sell fewer, sell
Hmm.
one or two or up to four contracts, well, now your risk graph's going to have some deltas up
Now
here,
you got a little bit
a little
going
bit
up.
of
Yeah.
upside, which I think is probably the way that we would lean in most cases. But the thing to emphasize for all of you new traders who have heard about covered calls and thinking that it's free money, push button, get cash, don't forget this down here. This is the risk. Okay, you've got unlimited your long deltas, your long shares of stock. If that stock falls down here, that call is worthless, not providing any more of a downside hedge, but you're getting longer, right? Those deltas are getting right there to one. It
Yeah,
reminds me, it
your
reminds me,
option.
Stu, when I lived in Orlando, there's a kind of a cheesy little tourist trap called Gatorland, and they'd have these
Yeah.
gator wrestling things out there, and the guy would be sitting on the gator holding the jaws of the gator, and he'd ask the audience, what's the most dangerous part of the gator? And the audience in unison would yell, the tail, right? Everybody has heard that the alligator is what they use to, swat people down with. Everybody's heard that it's the tail. And the guy says, now take a look at what part of the gator I'm holding. And they go, oh yeah, maybe it's those teeth with 3,000 pounds of 3,000 psi that might
Yeah,
be the danger.
yeah, it might
And
be.
it's the same thing here. People look at, oh, this is the big risk. I've heard that this is not your risk. Here's your
No,
teeth down here.
yeah.
So
Follow
make
the money. You know, I tell people that all the time.
yeah,
Just look at the money. If you take in $3, you have $3 that can go to zero, and that's going to be a $3 that you can do anything you want with. And the idea
correct.
here is to apply it towards a loss that you might get in the stock. But after the $3, that's it, right? You're still going
That's
to
it.
have your 100 shares, and the stock that's 97 might go to 90, and you're going to be out another $7, and there's no more money to cover it. So that's the downside that they'll
So
show.
part of the moral of the story is here, make real sure, especially if you're buying the stock just because you want to write that premium rich call, make real sure that you are comfortable holding this. Why? Because you are. And we hear that a lot. People say, oh, look at this. I can sell a 1 week option for $12. By the way, what does this company do? Don't do it. That that's taken all of this downside risk on, for a one-time fixed shot of money. It looks like free money. It's going to get you hurt. So that should also be part of your
Or
objective.
just know what it means. You know,
Know what it
it's
means.
understand that the $12 is there for a reason, and the
People are
reason
paying that because they don't want to hold the stock. They want you
because
to,
it's a monster stock, right? And it could
monster
easily be up or down 12 or $20, and
or more.
that's why it's priced the way it is. That's why it's called
Exactly.
hot,
Never
you know,
free.
in the future. Yeah.
So we can see that this blue line lets 30 days to expiration. As time passes, starts moving in. The distance between here, the red and the blue, or the red and the green, is time decay, or theta. And we can also see what's happening is that our gamma is starting to get bigger. That line's getting more curvature to it. All right, so this is what you have to do if you want to absorb that full $3. You've got to wait, in this example, for 30 days, all the time while holding this.
So Bill, what you just did there is you created those lines. Each line represents a time in the future.
Yeah, so I think when I did this, that was 30 days to expiration, and then each one was, I think was, I think it was 5 days less.
Yeah,
I
yeah,
think each
really
one was
cool. By the
five
way,
days less.
side note, everyone, I don't know about other platforms. I use Thinkorswim. Thinkorswim can create this exact thing
Yes,
on your risk
step
profile
sizes. Yep,
where you can actually look at these up. I think it's up to 5 lines,
five of
4 or
them.
5
Yeah,
of different points into the future to show you what your P&Ls might look like, and
yeah, very
as well as
cool.
your other grades as well. Really, really great feature on Thinkorswim.
Very cool. So there's no excuse for saying you didn't know. So, in addition to understanding the big picture, let's get to the three calculations. Now, again, this is really what's going to help you make decisions. So, there are some return calculations, and the first one is the static return. We have another called the return if exercised, and then we have the break even return. So, we're going to take a look at all three of these. So, let's go ahead and do that. And before we do, please remember marketrebellion.com/get started. Lots of free stuff on the website to help you make better decisions with trading. So, covered call. Let's say that we buy 100 shares for 100. We're going to sell this 30-day 105 call for 3. All right, that's our setup. What's the static return? Now, static return means that the stock price remains the same at expiration. Now, don't confuse that to mean that it has to stay the same between now and expiration. That's virtually impossible.
Which it won't. Right.
We're just right, which it won't. We're just saying that it's 100 today. It could bounce all over, but when we get to expiration, it's still at 100. So if we spent 100, we collected 3, our cost basis is 97. What's the static return? The static return is that we collected, and I'm sorry, that should have been, I thought I changed that. It should have been 3 divided by our 97 cost basis. So it's going to be a little over 2%. And the question that you have to say is that acceptable? Is that something that is okay to meet my goals? And then annualized, multiply it by 12 is going to be almost 25%. So one thing to look at is if you're going, well, gee, I'm not looking to get 25% of my portfolio. Maybe I should write it in the money so I can have a better downside hedge. All right, so these are some things that will help you to make those decisions. The second thing is the return if exercised. So this assumes the long position exercises. Remember, you're the short position. So again, technically that you are getting assigned.
Yeah, how
So
come
again,
they don't call it return if assigned?
I know because you're the covered call and they're saying the return if the long exercises, but you're not the long. I know it's a weird.
It should be assigned, I
I know,
think.
I agree, but that's just what they call it.
I think the world should actually just listen to me. We'd be better
So
off.
again, the stock is 100. We spent for it, or at least that's its current price. We collected 3. Cost basis is 97. Let's say that we get assigned. That means we sold our shares for the strike at 105. All right, so now step through the math. What's the return if exercised? Well, now we made $8, right? We collected 5 capital gain plus 3 from, I'm so sorry. Hold on just a second here. Plus we made 3 from the call for 8.2% return, and the annualized is almost 99%. So this is where people have to say, am I trying for 100% annualized returns? And if not, this is probably not a good choice.
So, the big picture is, what does this tell you? When you work out this math, this is a 30-day call, Bill?
30-day, yeah.
Yeah. When you work this out and you come up with this stupid 99% number, which really is ridiculous, what does that tell you? Does that tell you that maybe there's too much of
You're
something going
taking
on
too
here?
much risk.
There's too much risk. You're getting a great return if it happens that way,
but that's not the point.
You're taking a lot of risk to get it. I mean, more risk, more, more P&L
Right.
which includes L. So, you got to keep that in mind.
So this is the problem where, again, a lot of people say, "Oh, well, look at this. I can make $8. That's good." Well, we could also make it to where you could make 20 or 30 or 50. It's not about we can always show you a strategy where you can make more. The question is it going to help you meet your goal? Are you willing to hold that risk to get it? So again, if you're seeing numbers like this and you're going 8.2% in 30 days, that's way more than I'm looking for. I would go more in the money. Maybe bring it down to 100 strike. That's a different conversation, but it'll still have that'll actually have the most extrinsic value. Or go in the money, go to the 95. That'll still have theoretically would be the same as going 5 points out.
Yeah, it'll be close.
It'll be close. You should be about $5 plus $3. But the point is, at least now you've got more of an $8 downside hedge. So again, this is what's going to help you make those decisions.
And that's right, everyone. Bill did allude to selling the call that's in the money. That is absolutely correct. You heard him right.
Yes,
Those calls have
most
extrinsic
people never
value,
think of.
and that is that extrinsic value is going to zero. You are getting the additional intrinsic value as your hedge to the downside as well. You have more delta in those calls. The overall position will have less delta net. So it's a trade-off. There's you're not going to have that capital gain that you will if you sold the 105s versus the 95.
Right. Exactly. So again, it's this idea of thinking, it's not a question of is it good or is it a lot of money? Is it what you need? Because remember, you're taking a certain amount of risk for that. So I would look at it, for me, I would say 8% a month, that's way too high. And people say, yes, but it's a lot of money. Again, see, we start going in circles. That's not the point. I'm not willing to take that kind of risk for the goals that I'm trying to do. So I would probably, if that's a lot of juice for a 105 call
Yeah,
for 30 days. I mean, I would
$3
certainly
on
go to the
that.
95.
That's a high vol stock.
That would be a very high vol.
Yeah.
And I did it really honestly. I should have explained that, but to make the risk graphs separate out so people could see those risk curves. Otherwise, they're all crunched in there and you can't see them. But at any rate, that's the way that you would have to approach the decision. Now, the last return isn't really a return. I don't know why they call it that, but that's why they call it the break-even return. And this assumes that you just break even, which we talked about before. This is super important because it shows you the size of your downside hedge, not only in dollars but in percentages. So again, our stock is 100. Sell the 105 call for 3. Cost basis is 97. There's your answer right there. Okay, I can have it fall to 97 and just break even, or which is $3. And so the break even return is the $3 divided by the $100 starting point, right? We fell from 100 down to 97, or 3%. So I've got a 3% downside hedge. So now we can balance things. If the stock goes nowhere, the static return, is that going to be acceptable? If I get assigned, is that going to be acceptable? And is my downside hedge going to be acceptable? And if you blend all three of them, in my view, I think kind of focusing on this right here, this is the main reason for doing a covered call. But focus on that. But at the same time, we don't want to go so far in the money that we get a 15% downside hedge and a static return of virtually zero. So again, it's a blend, it's a juggling act. So quick reminder, marketrebellion.com/get started for topics just like this to help you make good decisions. So again, balance is the key. A good covered call balances all three calculations. And it's okay to lean towards one calculation or another. If you're a little more aggressive, you might be looking at the return if exercised or assigned. Or if you're more worried about the downside hedge, you might lean towards the break even. But don't just focus on one. Now, here is a common mistake. This is what we get all of the time. So we assume that the long position gets assigned. The stock is 100. we sell the 120 call and we get 10 cents. Oh boy, free money. There's no way the stock's going to get there. I have a
Or
cost
this, or
basis,
this. I want to sell my stock at 120, so
or I
I'm
want
going
to sell my stock at 120. Well, so do
I
I.
hear that.
Right. That's not going to help it. Your cost basis is now reduced by a whopping 10 cents. But if we do get assigned, we get to sell the shares for 120. So look at our return if exercised. We sell for 120 on a cost basis of 99.90, basically a 20% return, right? Roughly from the stock going from 100 to 120, because this just didn't do a whole lot for us. And on an annualized basis, about 240%. And so people go, unbelievable. This covered call makes so much money. It's just a magical strategy. The covered call made you 10 cents. The 99.9% of this return is from the stock going from 100 to 120, which it would have done even if options didn't exist.
Yeah, this is amazing.
And we see that a lot from people. They all want to sell these super far out of the money. They think because they think that's the game. Don't
See,
get called out, right? They always call it getting called out, but try to pick up the free money.
yeah.
It's not it at all. And that's what's going to make it confusing versus what you hear on, we always call them the YouTubers out there, people who have no experience and tell you this is what the game is and why it tends to conflict what Stu and I typically talk about in Q&A because we're
If you think
looking
it
at these
through,
three calculations.
it makes perfect sense, but you got to be able to think it through.
You got
So
to think
here's
it through.
a real quick think through. Ready? So why would you get assigned? Well, I might get assigned if the stock is over 120. Well, if the stock is over 120, then that means you could sell the stock, right? I mean, just hit button, sell stock, get 120 for it, or
That's right.
121,
Right.
22. What did the 10 cents do for you?
It added 10 cents to your return. That's where the 0.1's coming
You
in.
gave yourself an obligation for basically
For
nothing.
nothing. Let's call it nothing. Right.
For nothing.
Right.
When you could have accomplished the exact same thing and had that upside ability or opportunity without having your hands tied behind your back from your obligation of selling the call. You got to get paid for the obligation. Getting paid 10 cents in my book isn't really getting paid.
It's right. And let's also not forget back when NVIDIA went from 100 to 700, if this thing is going to go, it's probably not going to go from 100 to 120 and stop. It might be on fire. It might be on its way to 200. And here
maybe.
you are, you gave it up for 10 cents. It's just not a good thing. And the reason is people have this perspective, I want the free money and I don't want to get called out or assigned. Remember, that's the best you can do. That's not the way the game is played. The game is played about blending these three calculations, focusing on not solely, but focusing on the downside hedge. So Stu, let's get back to our chalk talk question. Stock is 130-day 110 call trading for 20 cents. What do you think? What would you do here?
Well, I wouldn't sell it, but I mean,
I wouldn't. Now,
that's
that's
me.
not saying that people don't, but again, from a professional trading standpoint, it's just not.
Now, look, here's a little offshoot, people. So if you are maybe you don't have the stock and maybe you're thinking about a vertical spread.
Yeah.
And the sale leg is the 110, or you're looking at the 110. Do you really need the 20 cents to help protect your long option, which might be, whatever it is, $3, $4, $5, whatever it is. Do you really need the 20 cents? It's like, which one do I sell when I do the vertical spread? Well, maybe one of the answers is you don't really have to sell any of them. Maybe you could
It's
just
always
be
a choice. Do
long.
nothing. Correct.
Maybe you could just be long the anchor and not have to sell something against it. Always remember when you sell, the sale is hedging the long.
That's right.
Do you want even the hedge? Just
That's
because
a good question.
is vertical spread and you feel like doing a vertical spread, it doesn't necessarily mean that you need to make a sale. Maybe you just need to be long the option.
And is the hedge adequate?
Is
It's
it
not
enough?
about,
That's what
everybody
I'm trying
thinks
to
it's
say,
about the
right? Is it
free
enough?
money. And
Maybe you need to sell the 105s. I mean, if you really want the hedge and you need some money to make it a hedge, then maybe the 107 and a half, or if you got dollar strikes, something other. But
yeah,
20 cents in
bring
my
them
mind
over.
isn't cutting it.
Yeah, I think this would be a clear no way because again, when people talk about something like this, I can already tell you they think the game is played about let me sell something so far out of the money that I have no chance of getting assigned, but I'm going to just pick up some free money. And can you do it? Of course. Yeah, we could push the button and sell it, but it's not the design of the strategy. You're
Mhm.
holding all that downside risk. You got a 20-cent downside hedge. You've still sold off the upside. It's just not a good choice. And to really succeed in this business, you have to make good choices. So we hope that helps. Again, we get that question a lot in our Q&A, and I know we've got a lot of new people in the group. And so we hope that helps you to make better decisions with the covered call. And so with that, thanks for joining us here, and we will see you next Thursday for our next edition of Coach's Corner. We'll see you then.
See ya.